It would appear these markets are on a tear. Ed Bell, Senior Director, Market Economics, Emirates MBD. Ed, is there anything in between $72.50? The markets opened again in Asia this morning, looking quite robust. It's sort of like a bath overflowing. It's hard to see where there's going to be a block to get to $80 a barrel.
Yeah, certainly. I think it's also quite hard to point out a single catalyst to say why we are continuing to go higher. I mean, obviously the market is being supported by the restraints on the supply that we have from OPEC plus, a reasonably strong narrative around demand recovering in big developed markets like the United States, increasingly parts of the EU as well as China. Although just as equally every day you see when the oil price goes down, it's because of demand anxiety or demand concerns. So the moves going higher, I think it is kind of hard to single what is really going to allow us to get up to $80 a barrel, particularly, or even $75 a barrel, particularly if we do have this still pending hang of enormous amounts of spare capacity coming from OPEC producers themselves, so they could easily bring a lot more of that back in the second half of the year. I think, the markets are really taking pricing in the uncertainty that we had from OPEC plus at their last meeting, where they didn't really give an outline as to what they're thinking about for the next 6 months beyond July, really, in terms of what kind of production levels they're thinking about, and taking that uncertainty as a positive for this market, at least in terms of supply being quite tight going forward.
Kate Durian, Meese contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington, based in London. Kate, lovely to have you back on our table. It would appear that our old friend Prince Abdulaziz has really started to successfully implement, as he has described, his hero, Alan Greenspan, central bank federal chairman for many years, on the grounds that the spare capacity that OPEC now has is clearly like a federal chairman has an interest rate. It's not about supply, it's about tweaking the ability on the market. And last week, of course, he chose not to do so.
Yeah, I think he did say that they would be meeting every month to sort of stay attentive, as he said, to the market and won't leave the market, to sort of drift out of their control. But I think that there's so many other unknowns. You have, at the point when they met, the Iranian talks were going on, the Iran nuclear talks were going on in Vienna, and there was some speculation that Iran might return. I mean, Iran might return is a bit of a misnomer, because they have returned. They are exporting somewhere between 800 and 600 and 800,000 barrels a day. And on top of that, I think if the sanctions continue, Iran has gotten used to, selling its oil despite the sanctions. So you might see that ramping up if there is demand. And of course, you see, countries like China and India, which is very sensitive to price rises, might be tempted to say, if they're offering it at a discount, maybe not so much India, because they don't normally buy, sanctioned Iranian oil, but China definitely, if demand picks up. At the moment, we're not seeing that. So I think there was that unknown. So they may be wanting to wait a little bit. The Iranian elections are coming up, and beyond that, the situation might change.
Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, one of the sort of principal differences between OPEC perhaps and central bank governors at the moment is that OPEC's forward guidance is only 30 days now, or whatever, a month or two, whereas the Federal Reserve keep telling us every week, we're not going to raise interest rate for years and years, whereas the OPEC Plus and Saudi Arabia are basically saying, yeah, we'll tell you next month what we're going to do.
Well, I'm glad we started there, Sean, because I like the narrative that central banks have basically have an upper hand compared to OPEC. OPEC is having diminishing ability. They have the diminishing part of the global market. They just push prices, WTI prices now, the highest price I have in my database above the cost of production since 2014. We're about 75% above the cost of production. Their spare capacity is the greatest ever. And I sense a little bit too much bullishness at the upper end of range and an enduring fundamentally bearish bull market, fundamentally bear market. So I view OPEC and crude oil as extremely vulnerable here. And then I look over what central banks are doing, and I look at gold and silver. I see enduring bull markets that have had significant corrections that look like they're ready to just take off. So I look in as a commodity guy. You asked earlier about what's driving it, and what I see, and Ed mentioned the spare capacity. What I see driving is massive inflows in commodity ETFs, commodity investors, which are buying the wrong things at the wrong time. I say, if you're bullish commodities, buy metals, buy gold, silver, platinum, palladium, copper, but not crude oil here. And I think that's what's happening. I think it's extremely risky. And just look forward.
We're seeing for the first time, in this run, we're seeing WTI close over 70. I mean, the American oil, very much for American market, big demand.
Well, it's demand. Let's look at the motor fuel demand. It's running around, catching up to around 9 million barrels a day. It's the same as it was in 2007. So what's surprising?
And it was $100 then.
I think exactly. So what's happening? That's a macro, fundamentally bearish market, and we're at the upper end of the range. Sure, so I view it right here. If we just get let's say if we get a 10% correction in the stock market, crude oil is dropping 40%. So it's all, to me, a house of cards right here. And comparing where you started with OPEC versus the Fed's got every incentive in the world to keep, and central banks to keep interest rates low because of these substantial deflationary forces in the big picture, i.e. the cost of production for crude oil in this country is around $44 a barrel. It used to be just a couple of years ago, it was $70 a barrel, yet prices have declined. That's just advancing technology. So that's why I look at the commodity standpoint, selling crude oil, buying gold.
Ed, again, coming back to the sort of starting point, what sort of hurdle is out in front of this oil market now? One might be the inflation. The CPI forecast is coming later this week, expected to be over 4% for May. That's obviously a big number for inflation.
Yeah, certainly. I think when we look across not just the oil market, but commodity markets generally, and into rates and equities as well, expectations is for US CPI to come in actually closer to 5%, about 4.7% for the May number. But it's interesting, even though we have been having these elevated inflation prints over the last couple of months, US Treasury yields have come off quite considerably since where they peaked at towards the end of March, pardon me. So around that time, we're coming in on 1.75%. This morning, we're at 1.53%. So it does kind of seem that the market is at least accepting the narrative from the Fed that they are going to be maintaining this accommodative policy in the face of what is going to be elevated inflation. I mean, every day you can read dozens of editorials from past FOMC members or previous people who've been economists in the US Treasury Department saying the Fed is making all the wrong decisions, the Biden administration is fueling inflation, et cetera, et cetera. But seemingly that's not being reflected in the market as we stand right now. Nevertheless, I think we're still going to have those jitters around the kind of monthly inflation prints. Interestingly, we had Chinese inflation data come out this morning. The producer price inflation was very strong at 9%, but crucially, we're not seeing that being passed through to the consumers in China at this stage. So CPI inflation is just 1.3% and has really been lagging producer price inflation, which is being driven by a lot of the shortages and supply chain issues really since the start of 2021. But we're not seeing that being passed through into consumers and really feeding through into other markets just yet. So it does seem that markets are accepting that the Fed or central banks aren't in any rush to raise rates or pull back on any kind of stimulus measures just yet. We might see some more tweaking of policy on the side, particularly at least in China, in terms of pulling back on some of the kind of more stimulatory measures to support growth or support consumption rather than on the monetary policy side.
Kate, it does appear that inventories as of and yesterday, the API number came out showing a big draw at over 2 million barrels. We'll see the EIA report out today. It does appear that OPEC Plus have taken a fairly robust attitude towards inventories, given that we are down at very close to 5-year averages, and yet OPEC are unrelenting.
Yeah, it depends on which 5 years you're looking at. You know, every time you talk to them, they say, "Oh, you know, if you look at 2014," or so. I think that's one of the issues. I don't think. I mean, obviously they are looking at inventories, but what I think would be interesting is to look at China, to look at Russia, and what they, you know, how they feel about higher prices, because I don't think they would like to see prices go up to 75 or 80. So that
Why? What for a particular reason?
Well, because of the ruble, the taxes, you know, Russia doesn't particularly is more comfortable with prices at around 60, so 65. It's also about market share. It's also about gas, you know, to Asia, Brent-linked contracts to Asia, LNG and gas. So I think Russia's position will be quite interesting, and I think you might see that if prices keep going up, then the temptation to cash in, you know, by the likes of Iraq is going to be quite strong. You know, Iraq, you have Libya, which is outside the agreement, which is ramped up. They're pretty close to their capacity, so there's not going to be much more coming from that. But Iraq, certainly, if you look at their numbers, they're at about 88% compliance with the OPEC cuts. So, you know, OPEC is still withholding about 5.8. They will be beyond July. They'll be withholding about 5.8, which could easily be brought on the market, the bulk of it in Saudi Arabia. So I think that's an interesting dynamic to look at.
Mike, another big factor in this market for some time now, and all markets ultimately, has been the fiscal stimulus, particularly out of the US, and the infrastructure bill, which is now in Congress. And it would appear that the talks with the Republicans have sort of fallen apart, and will be the Democrats' job to get it across the line just by themselves. Your outlook for that and its relevance and impact?
There's a race for the midterms in this country, and the Biden administration knows what's happened historically. Usually you switch back during the midterms. So if you're going to get anything done, you've got a bias, you've got a majority, you got to do it now. So expect as much fiscal stimulus as humanly possible until they get to the midterms. It's also buying votes. So that's part of the reason I'm more bullish gold and silver and the precious metals and Bitcoin in that fact. And I like what Kate and Ed both pointed out, is just pointing out the fact that there's a major dichotomy here that's developing between high elasticity supply commodities, i.e. crude oil and corn, and low elasticity supplies, i.e. gold, silver, and Bitcoin. And I fully expect the low elasticity supply commodities to do much better from these levels. But fiscal stimulus wise, you got to prime the pumps. Now's the time, because come 2022, and we get to those midterms, that's when you lose your majority, if history isn't a guide.
Do you think that the Democrats will have the votes in the Senate to get this across the line, with the somewhat reluctant Joe Manchin of West Virginia, the sort of very conservative Democratic senator? He seems to hold a lot of power right now.
Well, that's the key thing. If not now, is it going to be better after the midterms? You got to nail that, hit that iron hard, and sway the votes, because after the midterms, it's very likely you're going to lose the majority or have less power than now. It's just how it's always happened, and Biden administration is well aware of it.
Ed, we have a pretty unique situation here in the Gulf, where typically the summertime, particularly in Saudi Arabia and Kuwait, it burns a lot of liquids for power. We're seeing that this summer now is already sort of above normal heat, above 50 degrees centigrade. If people outside the region can comprehend that, I'm wondering what your outlook and the impact that may have in the region.
Well, I think, there can be quite short-term cyclical factors in terms of responding to the higher kind of air conditioning needs and cooling needs across the region. So I don't think we'll get a persistent trend. And even if we did have an excess pull on domestic availability of crude for power generation. As we said, we are sitting on quite a lot of spare capacity to be able to throw that into burners to get to meet the electricity demand. I mean, I think we have seen over the past couple of years, though, a big shift, particularly from Saudi, to try and bring in more gas and gas-fired generation to ease up on the necessity to burn crude for power generation. So we would expect to see that trend to continue to play out over the next couple of months, really, or the next couple of years, really.
Kate, we're seeing quite a relatively strong recovery in India. The refineries there are getting runs back up about 85%. There's congestion and traffic jams back in New Delhi. Despite this sort of last month of horror in India, the economy is grinding back to operational normal, even though vaccination rates are low throughout Asia. It's not having that much impact on dampening this demand recovery. You're on mute, Kate, sorry.
I thought I'd unmuted. Yeah, I think you're seeing demand coming back. You're seeing refineries coming back from maintenance. And I think it was on your show yesterday that, they're buying again from Saudi Arabia, even though they've complained about OPEC's policy sort of keeping prices higher. Whether you'll see a pickup beyond now, I don't know, because at 72 plus prices, I think India may try to sort of limit its imports because as it recovers, it's been hard hit. Vaccination rollout isn't going to really happen immediately. They're still pretty far behind. So you're talking
Saudi
end of year, maybe.
Prince Abdulaziz won't be too disappointed if both India and China drain some of their very large inventories that they built last year when the price was cheap.
Yeah, that's true. I mean, that's what China was doing. They have been dipping into their reserves, and also the price controls. So I think you might see that Chinese demand will. And I think it is also cyclical. It's not going to be. You can't look at China 1 month and say, oh, demand is going to be depressed because prices are high. The Chinese aren't as sensitive to prices as India is. But I think what's interesting is if we heard Prince Abdulaziz the other day, either he was taunting the IEA and saying, we might expand capacity beyond 13. Don't be surprised if we come with an announcement saying we go beyond 13 million barrels a day. And of course, they're sort of looking at what's going on with the international oil companies, with the climate activists, and saying we're actually in a pretty good position, now, if we expand capacity, because we do see demand for oil going up, no matter what the IEA or anybody else says. So I think there was also a message there.
Mike, we've seen in the last week, obviously, dramatic events around the US oil majors, particularly ExxonMobil, which is sort of three activist board members being imposed on the board there. Is that the end of this cycle of squeezing the majors in the US, or what's the outlook for that?
Yeah, I don't know exactly where that's going to go. I view that as more kind of the noise, but the big picture, I look at the macro. And I have a chart in front of me right now. I show that price of WTI is 74% above the cost of production in the US. That's the highest I have in my database for 6 years. So just the simple rules of economics as a macroeconomic economist, expect supply. And it's just, there's this attitude in Texas, this saying called get her done. And yeah, I get all the ESG, but people will find ways to bring on production when you have almost guaranteed profits. So that's what I see coming from the US.
But ultimately, that is probably the surprise of the year. Not so much that OPEC is controlling supply. I mean, that's sort of their strategy and they've stated it. But the fact that US production has been so slow to return at these levels has to be the shock of the year.
Exactly. Well, you got to expect that to stay the same. You have to expect things to be different. Economics not to matter, price not to matter, and things like that. So I always stick with the facts, and that is there's a massive incentive to produce crude oil here, just like I see corn and soybeans. There's massive incentive to produce the low elasticity supply commodities. I mean, they're high elasticity supply commodities. There's a pretty good incentive to produce them. I fully expect massive production.
Let's go to the survey question and let the room have a view on some of these issues. Global oil inventories are likely to drop well below 5-year average in the second half of this year. it strikes me that OPEC Plus are not targeting just the 5-year average, whichever years you want to take. But if one takes this sort of 2016 to 20 or whatever it might be, but they're clearly going potentially well below that. That's the question. Agree or disagree with the statement? Welcome your thoughts on that. Ed, from the point of view of OPEC plus strategy, Saudi Arabia are carrying the heaviest bucket here. They're seeing their, a year ago plus at the start of this journey, their sort of standoff with Russia about everything being equal. But Saudi are clearly more than 1 million barrels below Russia now. Saudi 8.5, Russia 9.5. How long do you think that will continue? And what, from the point of view of the Saudi economy recovering, what are the consequences?
Yeah, I mean, this is the kind of traditional broken calculus of any kind of production agreement like we have with OPEC Plus, is if you have one country that makes a sacrifice of itself to support everybody else, and it expects that they also take some of the hard medicine and keep their production restrained. If they don't see that, then they may not be as incentivized to carry on with that kind of behavior. So we had that explode into the price war we saw in March and April last year. We don't think that it's going to happen again this year, but there's no reason to say that it can't or that it wouldn't if Saudi Arabia, for instance, sees other producers taking advantage of their benevolence, let's say, in terms of allowing market share. And I think that's where I don't really find the analogy between OPEC Plus and central banks quite like for like. If you look at the FOMC in the United States, it's not Minneapolis versus Virginia or versus New York versus Dallas. These parts of the United States Fed are not competing against each other for the exact benefit of their local economies. And so the inherent structure of OPEC Plus is that these countries, yes, they all have an interest in the oil price being high, but if they can get it at the benefit of somebody else being punished or not having their economy perform as well, they have every reason to take it. There is this calculation, though, I think that any OPEC producer has to take is you keep production restrained for however long you can to allow prices to support, and then you have countries will be chomping at the bit to increase production. We see that flare up various times to time. We saw that most evidently in the December meetings when there was a lot of uncertainty about whether the UAE, for instance, was going to continue to stick to its OPEC targets. We see perennial kind of, I think, that sort of chirping at the sidelines around the OPEC meetings that these deals can't last forever. And that's one of the things that has been most extraordinary about this OPEC agreement, that it was meant to last for so long, signed in 2020 and to last for at least almost about 2.5 years, quite an enormous amount of time for these countries to put a large part of their economies on ice for quite a long time.
This price, Ed, the fact that the OPEC Plus are supporting a more aggressive price is softened by the weak dollar, which of course at the moment for the likes of Dubai is a good thing for the point of view of the recovery of the Dubai economy. How do you see that playing out for the emerging economies in India and elsewhere? India are not screaming like they were at $60, $65 a barrel.
Yeah, certainly. I think we have seen for emerging markets pretty much across the board. There are some exceptions. It's not been a bad second quarter. So bond yields across a lot of emerging markets have come down quite considerably. Several currencies have done decently in the last couple of weeks as well. South African Rand, for instance, is one that's really standing out when you think where the South African economy started the year, given the really bad outbreak and the conditions around the virus there. There are some standouts where that's not the case. Obviously, Turkey is going through a different economic cycle, diverging monetary policy phase, let's say. But nevertheless, I think we are in a little bit of a temporary sweet spot for emerging markets. And they're really, I think, going to be focused less on the story around oil prices and what OPEC Plus does, and more on what something like the Fed or the ECB does. So if we get an inkling that the Fed is going to not raise rates, for instance, but say pull back on stimulus in terms of the amount of bonds that they're buying every month, then you could see a bit more of an adjustment that could be a bit sharper, perhaps a bit more violent in some of those emerging markets.
Well, the weaker dollar may set up Dubai for a bumper tourist season coming up, and real estate here is booming as well, and that's bringing in a lot of euros and other currencies. So perhaps that weak dollar has that sweet spot, as you say, at the moment. Kate, the big unknown, it seems that the sort of changed, we noted earlier, the expectation that an Iran deal was imminent. Now they get back to the table tomorrow for what many are saying are the sort of D-Day of the final talks, either make or break. Your outlook for that, what do you think is the big hurdle?
Well, the big hurdle is, I think, Iran sort of taking one step forward, two steps back, as they tend to do. I think it's going to be very difficult if you don't get a deal before the elections. Raisi is the front runner,
which is essentially next week.
Which is essentially next week. So yeah, it's highly unlikely. And even if they did come to a deal, there's so much that's left. I mean, we heard Blinken yesterday say there's still going to be dozens, hundreds of sanctions that were in place, that were put in place by the Trump administration, that aren't going to be removed. So you have the banking and the shipping and the insurance. I mean, there's just so much to unwind that we're not going to see. Even if you get a deal, you're not going to see that much Iranian oil coming back to the market before the end of the year, maybe next year. So I think, and also the potential of what might happen if you do get a hardliner win the presidential election. I mean, there hasn't been that much opposition in Iran at the moment, but I think it's getting to a point where inflation is so high, unemployment in Iran, that you do need to have some relief from sanctions. So I think that's an interesting one to look at. And of course, OPEC Plus seem to want to keep the market guessing, to keep speculators at bay. So they say, yeah, we'll meet every month and we'll let you know what we're going to do. But, the potential for leakage is there. As you mentioned, Saudi Arabia is producing 8.4, 8.5. And Russian, over 9. Of course, that will come up. Saudi production will come up as they unwind the last of their 1 million barrel.
I mean, typically in the past, Kate, would you say OPEC does or does not have a sensitivity towards the impact on emerging economies? They have always said they do, but has it really guided policy in the past?
I think, when prices were 100 plus, yes, but not at the moment. I think they're just, they need the stimulus as well. They need the oil revenue, even if they are recovering slightly better. I mean, if you look at the region as a whole, it's not an even recovery. So I think Saudi Arabia needs the funding. Saudi Aramco is highly indebted now. So I think they're also recovering from the pandemic, and they need a lot of these sectors that were hit. Tourism, as you mentioned, tourism, aviation, the service industry, even trade, transshipment for the likes of Dubai. So I think they're sort of putting that aside for now and saying, okay, yeah, we need to recover our economies as well.
Yeah, I think on that grounds, you would probably, in order to understand their perspective, you would need to sort of take an average oil price of 2020 and 2021 to get a sense of where they're coming from, which is obviously well below 70 when you take an average over the last 18 months. Mm-hmm. Let's get the survey question result and give Mike the last word. Agree, likely to drop well below 5-year average, 2-1. Agree on that view. Mike, your thoughts, just to pick up on that piece on Iran, whether this is something, do you think that the American Biden has political cover for, or unlikely to take any chance where he might get kicked in the shins by the Republicans for appearing soft?
Bashing Iran, bashing China in this country gets votes. So what does Biden want to do? Get votes. So let's just remember that. But I think Iran, as Kate pointed out, and Ed Penoy, is just an example of the overhang of massive supply and the elasticity of supply in crude oil. There's Iran, then there's, of course, Saudi Arabia, there's overall OPEC, then there's Russia, there's Brazil, there's Canada, there's US. There's massive supply coming on at higher prices. So I see limited upside for crude oil. I view it as enduring bear market at the upper end of the range. I view gold and silver as enduring bull markets. They've had substantial corrections. And part of that, as far as the last word, is I just saw yesterday is probably a good example of Bitcoin bottoming around 30,000. So gold and silver bullish, crude oil bearish.
Anything on the policy side you think, look, in America, which is clearly the sort of engine of OECD recovery, We're going to possibly look at a 10% Q2 growth. Anything there that could get any intervention from policymakers to try and calm this down?
It's complete life support at the moment. The most significant amount of fiscal and monetary stimulus in the absolute history of this country was kicked in the last 12 months. And guess what? Within about say 6 months from now, it's all going to go away. They're going to have to trigger more of it. So I fully expect this is the sugar high that's going to fade real fast. And part of that is a lot of supply coming in commodities, a lot of supply coming on in the Corn Belt. Crude oil probably peaking around 70. I like how Edward mentioned yields and bonds. Yields have probably peaked. And this is the peak of, this is the worst of COVID last year, a year after. Let's look at it 6 months, a year from now. The market's going to need massive more life support just to survive, because it's just the drug. It's not the cure.
Well, it's become an addicted drug, that's for sure.
Exactly.
Let's wrap it up there and thank our three guests. We have an interview today with the Secretary General of the International Chamber of Shipping. Quite a useful insight into some of the granular mechanics of the challenges that shipping is facing at the moment, and none other than simply getting the 1.6 million seafarer mariners that staff all of the global vessels who are basically not vaccinated, and that's causing an increased potential bottleneck. But other issues he touched on there, when you have 20 minutes, worth to listen to. Mike McGlone in New York, thank you so much. Kate Durian in London, really appreciate you getting up not too early these days, 7:30 of course in London with the beautiful spring weather, summer weather now. Ed Bell in Dubai, thanks Ed for joining us again this morning. All the best everybody, we'll catch up in the coming days. Thank you.